Imagine waking up to a world where every single person who has ever purchased Bitcoin, whether they invested at the very start in the late 2000s or just yesterday, is now holding their coins in profit. This is not a dream or a hypothetical scenario. It is now our reality. For the very first time in Bitcoin's 15-year history, not a single holder is at a loss. From the earliest pioneers who mined blocks on their laptops to the most recent buyer who took a chance during the latest dip, everyone is now sitting in the green. The significance of this moment cannot be overstated. Financial analysts, governments, and ordinary investors around the globe are sitting up and taking notice. Are we witnessing the birth of a new financial paradigm? Or is this merely a calm before another storm of volatility? What does this say about the future of money, technology, and our interconnected economic lives? To truly grasp the magnitude of this milestone, let's travel back to Bitcoin's origins. In January of 2009, the elusive Satoshi Nakamoto introduced Bitcoin's white paper, setting in motion a revolution. Born out of the ashes of the 2008 global financial meltdown, Bitcoin was envisioned as a lifeboat, a decentralized, peer-to-peer alternative to the centralized banking system, where the pillars of trust would be replaced by cryptography and computer code. The early years were filled with skepticism. Mainstream economists dismissed Bitcoin as an oddity, relevant only to libertarians, cryptographers, or those on the digital fringe. Transactions were fueled as much by ideology as by actual value. The iconic story of a programmer paying 10,000 Bitcoin for 2 pizzas in May of 2010, coins then worth just $40, but valued at more than $1 billion today, reminds us how far Bitcoin has come. The journey since then has been nothing short of extraordinary. Today, Bitcoin has blasted past the $111,000 threshold, setting an all-time high that has propelled every single one of the nearly 19,910,000 coins into profitability. This is not just a record for price, but a testament to widespread belief and participation. The Bitcoin network now boasts more than 1,200,000 active addresses, a historic summit. Each address is not just a statistic. It represents a real person, a business, or an institution connecting to a financial ecosystem that was pure science fiction a generation ago. According to a recent study by the Cambridge Center for Alternative Finance, over 3.2% of the world's population now owns some form of Bitcoin. That's nearly 260 million people. An astonishing figure, especially when you remember that Bitcoin was merely an academic experiment 15 years ago. Let's break that down. In just over a decade and a half, Bitcoin has grown from a handful of computer enthusiasts to a global movement rivaling the populations of entire continents. To put it in perspective, Bitcoin's total market capitalization now rivals the largest corporations in human history, comfortably sitting in the multi-trillion-dollar range. Its daily network processes the equivalent of billions of dollars in value, with a ripple effect that extends across the broader digital asset market. Ethereum, Cardano, and dozens of other cryptocurrencies are riding the same bullish momentum. Ethereum, for instance, has shattered its previous records, while XRP recently registered a golden cross, a bullish technical indicator. The current Bitcoin milestone is not just a singular event, but a tide lifting the entire crypto market to new heights. But the path to this moment has been anything but smooth. Bitcoin's history is a roller coaster of euphoric highs and gut-wrenching lows. In 2017, Bitcoin rocketed from less than $1,000 to nearly $20,000, capturing the imagination of the world. That bull run ended with a brutal correction, as Bitcoin lost more than 80% of its value. Critics declared the experiment over, yet Bitcoin proved its resilience, rising again in the years that followed. A crucial turning point arrived between 2020 and 2021, when institutional interest exploded. Major Wall Street firms, once skeptical, began to take Bitcoin seriously. MicroStrategy, led by the outspoken Michael Saylor, started accumulating Bitcoin as a core treasury asset. Today, MicroStrategy holds more than 252,000 coins, worth tens of billions of dollars at current prices, making it one of the world's single largest holders of Bitcoin, rivaling even some national central banks in terms of monetary reserves. This signaled a new era. Institutional adoption had moved from theory to reality. At the same time, regulatory acceptance started to take root. The United States approved Bitcoin futures exchange-traded funds, while countries like Australia greenlit spot Bitcoin ETFs. BlackRock's IBT ETF, backed by the world's largest asset manager, has consistently attracted inflows from both retail and institutional investors. These financial vehicles make it easier than ever for traditional investors to gain exposure to Bitcoin, opening the doors of the crypto market to pension funds, retirement accounts, and sovereign wealth funds. Technological advancements have also played a pivotal role. The Lightning Network, Bitcoin's Layer 2 solution, now supports more than 6,200 Bitcoin in capacity, enabling near-instant, ultra-low-cost transactions across the globe. This innovation directly addresses long-standing criticisms of Bitcoin's scalability and transaction fees. Suddenly, Bitcoin is not just a digital gold or a store of value, but a practical medium of exchange for everyday commerce. For instance, in El Salvador, where Bitcoin is legal tender, vendors and citizens are using the Lightning Network to buy groceries, pay for transportation, and even settle micropayments for digital services. Yet progress has not come without controversy. Bitcoin's energy consumption has ignited fierce debate, with some critics arguing that mining is environmentally unsustainable. But the story is evolving. In the second quarter of 2025, Bitcoin's total energy usage dropped by 30%, as more mining operations shifted to renewable sources such as hydroelectric, solar, and wind. According to Digiconomist, Bitcoin transactions still account for nearly 0.8% of global electricity consumption, but the momentum towards sustainability is undeniable. Some mining ventures are pioneering the use of otherwise wasted energy, such as capturing natural gas flares at oil fields or utilizing excess geothermal power to minimize their environmental footprint. In Iceland, for example, geothermal-powered mining facilities have become a showcase for green innovation. As Bitcoin's environmental impact comes under the microscope, new industry standards are emerging. The Crypto Climate Accord, modeled after the Paris Agreement, is rallying miners and companies to commit to net zero emissions. Major mining companies, like Marathon Digital Holdings and Bitfarms, now publish annual sustainability reports and are investing in solar farms and carbon offset projects. The narrative is shifting. Bitcoin mining is no longer just a race for profits, but a proving ground for the future of clean energy infrastructure. Against this dynamic backdrop, some of the world's leading financial thinkers are making bold predictions. Cathie Wood, founder of ARK Invest, projects that Bitcoin could reach a price of $1.5 million by the year 2030. Powered by relentless institutional adoption and the integration of Bitcoin into traditional financial products. Michael Saylor calls Bitcoin the apex property of the human race, arguing that it is the only form of money immune to both inflation and government intervention. Willy Woo, a respected on-chain analyst, believes that Bitcoin is still undervalued, even at these lofty levels, based on metrics that track the movement of coins between wallets and exchanges. Raoul Pal, founder of Real Vision, describes Bitcoin's trajectory as a secular uptrend, predicting that it will outperform nearly every other asset class over the coming decade. Lynn Alden, an investment strategist, underscores Bitcoin's scarcity, a maximum supply capped at 21 million coins, as a powerful hedge in an era where central banks are printing trillions of dollars in fiat currency. Plan B, famed for the stock-to-flow model, anticipates Bitcoin reaching $500,000 by the year 2026 if historical trends hold. Yet, beneath the euphoria, uncertainty is always present. After its recent surge, Bitcoin's price has already reversed some of its gains, reminding us that volatility is ever lurking. This legendary unpredictability is both a blessing and a curse. On one hand, it offers the potential for extraordinary returns. On the other, fortunes can vanish in the blink of an eye. The scars of past crashes, like the harrowing downturn of 2018, when Bitcoin plummeted by more than 80%, or the wild swings of 2021, remain fresh in the memories of many investors. Even now, with 100% of holders in profit, the market could pivot without warning. As institutions, and even entire nations, enter the Bitcoin ecosystem, the stakes are higher than ever. El Salvador, which became the first country to adopt Bitcoin as legal tender in 2021, is preparing to launch its much-anticipated Bitcoin bonds in the fourth quarter of 2025. These volcano bonds, as they are sometimes called, are designed to fund infrastructure and renewable energy projects, tapping into the country's geothermal potential. If successful, they could pave the way for other countries to follow, further weaving Bitcoin into the fabric of global finance. But such pioneering efforts come with challenges. Regulatory scrutiny is mounting worldwide, particularly when it comes to Bitcoin's environmental impact, tax treatment, and its potential for use in illicit transactions. Policymakers are struggling to balance innovation with the need for oversight. In the United States, agencies like the Securities and Exchange Commission and the Treasury Department are intensifying their focus on crypto assets. The European Union is rolling out comprehensive rules under its Markets in Crypto Assets framework, aiming to harmonize regulations across member states. In Asia, Singapore and Japan are experimenting with forward-thinking approaches, fostering innovation while implementing robust consumer protections. Meanwhile, China has doubled down on restrictions, banning crypto trading and mining altogether. This patchwork of global regulation creates risks and opportunities for investors, as rules can shift rapidly, impacting everything from market access to taxation. Adding another layer of complexity is the upcoming Bitcoin halving event, projected to occur in April of 2028. Halvings, which happen roughly every 4 years, are deeply embedded in Bitcoin's code and reduce the number of new coins miners receive as rewards. The next halving will cut block rewards to just over 1.5 coins per block, further tightening supply at a time when demand is surging. Historically, each halving has been followed by a significant price rally, but also by periods of intense volatility as markets adjust to the new equilibrium. Some analysts warn that this supply shock could amplify price swings, while others believe it will reinforce Bitcoin's narrative as a digital gold, a scarce, unforgeable asset in an era of monetary expansion. Let's project into the future. The next few years could define Bitcoin not just as an asset, but as a technological movement and a social force. With more than 3% of the global population now owning Bitcoin and network activity at all-time highs, mainstream adoption is a fact, not just a forecast. Institutions are playing an ever more dominant role, with Wall Street giants, hedge funds, and family offices quietly accumulating massive reserves. For example, MicroStrategy's holding of over 252,000 coins places it among the largest single entities with Bitcoin exposure, on par with or exceeding the reserves of entire national treasuries. Financial innovation continues apace. Exchange-traded funds and other crypto-linked products are bringing Bitcoin into the portfolios of retirees, pensioners, and governments. Sovereign wealth funds in regions like the Middle East and Asia are reportedly exploring direct or indirect exposure to Bitcoin, seeking diversification and protection against currency devaluation. The financial industry is undergoing a transformation, as traditional banks explore blockchain-powered settlement systems and even contemplate issuing their own digital currencies in response to the crypto movement. But even as Bitcoin celebrates this golden moment, shadows remain. Volatility is the ever-present wildcard. While spot Bitcoin ETFs are attracting billions of dollars in inflows and the Lightning Network's capacity continues to rise, risks persist. Regulatory crackdowns, especially those targeting environmental concerns, could trigger abrupt sell-offs or stifle innovation. Even though Bitcoin mining's energy consumption has dropped by 30% in the second quarter of 2025 due to the adoption of renewables, it still represents nearly 1% of global electricity usage. These figures are watched closely by regulators and environmental watchdogs alike. The forthcoming halving event, set for April of 2028, will slash block rewards to just over 1.5 coins, further tightening supply and potentially injecting fresh volatility into the market. As block rewards decrease, miners may face economic stress, especially if energy costs rise or Bitcoin's price fails to keep pace. This could lead to further consolidation in the mining industry, as only the most efficient operations survive, and could ultimately impact Bitcoin's decentralization. So what does all of this mean for you, the viewer? Whether you are a veteran investor, a curious newcomer, or a skeptic, this moment offers powerful lessons. The all-time profitability of Bitcoin signals that the asset class is maturing and entering a new phase of adoption, but it also serves as a reminder that markets are inherently cyclical. Every historic boom has been followed by corrections, sometimes sudden and severe. Remember the lessons from the crash of 2018, the wild volatility of 2021, and the countless mini-cycles in between. It is more important than ever to conduct thorough research, diversify your holdings, and avoid making emotional decisions based on price swings alone. If you are considering entering the space, pay close attention to on-chain metrics, regulatory developments, and technological upgrades such as Layer 2 solutions. Metrics like the number of active addresses, transaction volumes, and the flow of coins between wallets and exchanges can offer insight into the true health of the Bitcoin network. Keeping an eye on regulatory news is equally important, as sudden policy changes can have outsized impacts on the market. Technological advances, like improvements in the Lightning Network or potential breakthroughs in quantum-resistant cryptography, could shape the next wave of adoption. For those already invested, consider this. Many experts believe Bitcoin's scarcity and global reach make it a strong hedge against both inflation and geopolitical risk. With countries like El Salvador preparing to issue Bitcoin-backed bonds in late 2025, and millennials increasingly viewing Bitcoin as a store of value, the narrative is shifting from short-term speculation to long-term adoption. In fact, a recent survey revealed that 65% of millennials now trust Bitcoin for long-term savings, up from just 40% 2 years ago. This generational shift could have profound implications, as trillions of dollars in wealth transfer from older generations to digital natives over the coming decades. At the same time, Bitcoin is inspiring new use cases well beyond investment. Developers are building decentralized finance protocols, non-fungible token platforms, and new payment solutions on and around the Bitcoin network. Businesses in developing economies are leveraging Bitcoin to access global markets and bypass restrictive local banking systems. Humanitarian groups are using Bitcoin to provide aid in countries with unstable currencies or authoritarian regimes, demonstrating Bitcoin's potential as a tool for financial empowerment. Does this unprecedented profitability signal the dawn of lasting stability? The answer, as always, is nuanced. Institutional adoption, regulatory progress, and technological innovation are paving the way for a more robust and resilient market. But Bitcoin's DNA is disruptive by nature. The market is still likely to experience dramatic corrections, especially as new regulations, macroeconomic shocks, or technological challenges emerge. Yet with every milestone, Bitcoin draws closer to mainstream legitimacy, not just as a speculative asset, but as a platform for financial innovation and individual empowerment. Here is an often overlooked fact. Despite its wild reputation, the technology underlying Bitcoin is quietly transforming global finance. It enables peer-to-peer transactions across borders without intermediaries, offers an immutable ledger of value, and provides an alternative in places where traditional finance fails. This silent revolution might one day prove even more significant than price movements on a chart. So where do you stand in this unfolding story? Are you ready for the next chapter? If you found this analysis helpful, be sure to like, subscribe, and share your thoughts in the comments below. Do you believe Bitcoin's best days are still ahead? Or is the market primed for another twist? Stay tuned for more in-depth insights into the world's most disruptive technology.